afternoon, everyone, and welcome to EVPA's webinar, What is Ahead for the European Venture Philanthropy and Social Investment Sector, the EVPA Survey 2015-2016. It's a pleasure to welcome all of you to this session today. And my name is Alessa Giannoncelli, and I'm Research Manager at the European Venture Philanthropy Association, speaking to you from our office in Brussels. Before we dive into the topic of today's webinar, I would like to address a few housekeeping rules. Throughout this session, you will be able to open or hide the control panel, which is the console that appears on the right-hand side of your screen. At the end of the webinar, we will have 15 minutes for a Q&A session, during which our panelists will answer your questions. If you do have a question, don't hesitate to write it down in the questions section of the control panel at any moment during the session. Please don't forget to clearly mention to whom you would like to address your question. And written questions will be directed to the panelists during the Q&A time. If for some reason your question has not been answered during the webinar, feel free to contact us via email afterwards, and we will do the necessary follow-up. Since the number of participants in this webinar is very high, we are keeping all participants muted. Last but not least, note that this session is being recorded, and you should be able to watch the recording and consult this presentation as of next week on EVPA's website. If you encounter any technical issues, please don't hesitate to contact my colleague Margherita. You can find the number to reach her here on the slide or on our website. And you can also use the question section to let us know about any technical problem while connected to the webinar. Now that these housekeeping details are clear, I can introduce you my colleague Priscilla Boiardi, the EVPA Knowledge Center Director, who is responsible for the research, the dissemination, and the training offer, such as the 2 impact management workshops that will take place in Brussels on the 16th and 17th of March. And we will share some more details about them at the very end of the webinar. Priscilla will be moderating the second part of this webinar. Good afternoon, everyone. Good afternoon, Priscilla. Then, to comment the trends in the VPSI sector that became apparent from our survey, we have today 4 experts who represent the different voices in our community, ranging from grant-making foundations to social impact investing funds and academia, investing in a broad range of geographies from the UK to Africa, Central and Eastern Europe, and Latin America. So I'm glad to introduce you Lisa Himberger, who is a lecturer in strategy and general management at the Zade Business School, where she teaches and conducts research on social entrepreneurship, venture philanthropy, and social impact investment. Previously, Lisa was Research and Policy Director at EVPA, where she set up the Knowledge Center in 2010, and she still collaborates with us as a Research and Policy Advisor. Welcome, Lisa. Then, welcome to Caroline Mason, the CEO of Esme Fairbairn Foundation, a charity providing grants and social investment to organizations working in the arts, education, environment, and social change across the UK. Caroline also sits on the board of EVPA, and before joining the foundation, Caroline was CEO at Big Society Capital and Charity Bank. She was also the co-founder of Investing for Good, a social investment advisory firm, and one of the first community interest companies. Welcome, Caroline. And then today we have with us Elodie Noquette, who is the ESG and Impact Director at Investisseurs and Partenaires, a family of impact funds fully dedicated to sub-Saharan Africa. Investisseurs and Partenaires gathers 3 impact funds representing 75 million euros and supported about 60 small and medium enterprises located in 15 African countries. Welcome, Elodie. And last but not least, welcome to Daniel Novick, the Program Director for the Balkans at Yunus Social Business, which is a non-profit venture fund. Yunus turns donations into investments in sustainable social businesses that provide employment, education, healthcare, clean water, and clean energy to almost 1 million people worldwide. Dani is also an entrepreneur, and she has helped start 4 businesses in image manipulation, mobile payment, online marketing, and publishing. And he held various roles in startups such as CEO, CFO, and Head of Business Development. Then, to dive into the webinar structure, this is the agenda of today. To get everyone on the same page, I will briefly present you how at EVPA we describe the venture philanthropy. Then I will provide you with some preliminary information about the EVPA industry survey and some statistics on our respondents. After that, I will present you the survey's results divided in 3 parts. An overview of the venture philanthropy and social investment sector, the key trends identified, and the data linked to the VPSI approach implementation. Then, during the second part, moderated by Priscilla, our speakers will comment on the results, starting from their knowledge and experience. After listening to our speakers, we will have 15 minutes for Q&A, as already mentioned earlier. Let's start. So, what is venture philanthropy? Venture philanthropy is about matching the soul of philanthropy with the spirit of investing. And venture philanthropy is an high engagement and long-term approach to generating societal impact through 3 core practices. High engagement, since it's an hands-on relationship between the social enterprises or no-profit organizations and the venture philanthropist. Long-term, since it aims to support a limited number of organizations for a period of 4 to 6 years. As 3 core practices, as you can see in the graph, we have tailored financing, which is using a range of financing instruments, including grants, debt, equity, hybrid finance, tailored to the needs of the organization supported. Then we have organizational support, which is added value support services that venture philanthropy organizations offer to investees to strengthen their organizational resilience and financial sustainability. And at the end, we have impact measurement and management, which is measuring and managing the process of creating societal impact in order to maximize and optimize it. Let's talk now about the survey. Why at EVPA we think it's important to run an industry survey? So the purpose of our survey is to provide independent industry statistics, understand trends, inform further research, raise awareness about venture philanthropy and social investment in order to attract additional resources to the sector. So, talking now about our latest industry survey, it has been undertaken between March and June 2016, and it collects responses from 108 venture philanthropy and social investment organizations based in Europe, although their investment activity may take place in other continents. And 75 respondents are EVPA members and 33 are non-EVPA members. And compared to the past, there has been a 14% increase in the total number of respondents. So the majority of respondents are based in the UK, followed by the Netherlands, Germany, and France. The total number of countries represented increased from 18 in 2014, so the year when we ran the previous survey, to 21 in 2016. And several respondents are from Eastern Europe, with Bosnia, Bulgaria, Croatia, and Poland being represented for the first time. Now, let's look in depth at the results, starting from those data describing the venture philanthropy and social investment sector. And please keep in mind that the respondents, when filling in the questionnaire, were referring to fiscal year 2015. So, one of the most relevant questions we asked our respondents was how much they invested or allocated in the last fiscal year. And the answer we got is that, on average, they invested 7.8 million euros, which is in line with the amount invested by the respondents in the previous survey, as you can see on the slide. But venture philanthropy and social investment organizations support their investees not just financially, but also with a variety of non-financial support, ranging from strategic support to revenue strategy, financial management and fundraising, from support in developing the theory of change to support the development of day-to-day operations. European venture philanthropy organizations invest worldwide, but the bulk of funding allocated by our respondents is increasingly directed towards Western Europe. As you can see in our map, Africa is the second target region, attracting 14% of the funding. Then, in our latest survey, Latin America attracted 10% of funding, an interesting surge compared to the 3% registered for fiscal year 2013. But the market for venture philanthropy and social investment in Eastern Europe still remains limited, with the region attracting only 2% of total funding. But we will have the opportunity to better understand the specificities of this region in the second part of the webinar with one of our panelists. And maybe clarification is necessary regarding the zero funds allocated to Oceania, as you can see in the map. In the pie on the left, you can see that not all organizations set particular geographical criteria. So it's possible that part of the amount invested or granted with no specific geographical criteria was directed to this region. Venture philanthropy and social investment organizations support a wide range of sectors. In fiscal year 2015, economic and social development topped the sectors, receiving 24% of funding, ahead of financial inclusion, education, environment, and health. And altogether, the top 5 sectors shown on the slide made up for 79% of the total spend in fiscal year 2015. And then, of course, venture philanthropy organizations also target a wide range of beneficiaries through their investees. In fiscal year 2015, children and youth remain the main beneficiaries of EVPA investments, with 52% of European venture philanthropy organizations targeting this group, followed by people in poverty, women, people with disability, and unemployed people. And it's important to take in mind that this question is multiple choice with non-exclusive categories, and that means that the same investee organization might target more than one beneficiary group, such as children in poverty or immigrant women. European venture philanthropy organizations continue to invest across a spectrum of organizational types. As you can see on the slide, social enterprises and no-profit without training revenues are the key targets of EVPA investment, receiving 37% and 35% of the total spend respectively. And please note that with the label NGOs without training revenues, we are referring to those social purpose organizations that don't run activities that generate revenues, whereas by NGOs with trading, so the third category shown in the graph, we mean those social purpose organizations that also sustain their business model through commercial activities. And as already mentioned as one of the 3 core practices of the venture philanthropy approach, tailored financing is a reality for European philanthropy organizations. And as you can see in the graph, with the majority of our respondents adapting their financing model to the needs of the investees, either always in 32% of the cases or often in 27% of the cases. So, part 2. Let's now move to the trends identified while analyzing data from our survey. The first trend identified is that societal return is still the main priority for European venture philanthropy organizations. As you can see in the graph on the left, in the slide, 69% of respondents prioritize societal return over financial return. But an increasing number of venture philanthropy organizations expect positive financial returns from their investments, as you can see in the graph on the right. And it's important to keep in mind that we didn't survey those organizations that consider financial return as priority over social impact return, so finance first investors. Regarding the second trend identified, the majority of European venture philanthropy organizations still have annual budgets lower than 2.5 million euros. And it is also interesting to note that the percentage of organizations with large budgets, so over 15 million euros, increased compared to the past. And the first result can be explained by the fact that there are a number of new small organizations entering the VPSI market. And the second result highlights the important presence in the VPSI sector of large foundations. Then the third trend we identified is the increase in co-investment. And this is a very positive result, not only for the venture philanthropy and social investment sector, but also for EVPA, since as part of our mission, we aim to maximize societal impact through increased collaboration among actors in the ecosystem. And comparing this data with the result we got in the past, we saw that respondents who expressed in 2014 interest in co-investing, then last year, so in 2016, declared that they had co-invested, so willingness became reality at the end. And venture philanthropy and social investment organizations co-invest increasingly and primarily with their peers, such as other VPSI organizations and societal impact first investors. And interesting is to notice the sharp increase, so from 31% to 71%, as shown in the slide. And in the second part of the webinar, we will discuss further the advantages and potential issues of collaborating with other actors with one of our panelists. And now, the third and last part about our results is focused on those activities explicitly linked to the implementation of the venture philanthropy and social investment approach. So venture philanthropy and social investment organizations are increasing the duration of their commitment to the investees they support. And as you can see in the central part of the graph, the majority of venture philanthropy and social investment organizations are committing to support investees for a period between 2 and 6 years. Venture philanthropy is increasingly moving towards long-term engagement, with the share of VPSI organizations investing for less than 2 years decreasing, whereas the share of organizations investing for a period between 6 and 10 years increasing. Then VPOs increasingly understand how to manage impact by measuring at the level of outcomes instead of trying to measure impact. And compared to 2014, there has been a decrease in the percentage of venture philanthropy and social investment organizations trying to measure impact, which requires an assessment of attribution, showing that venture philanthropy organizations are increasingly becoming aware of the difficulty of measuring impact. And we will have the chance to have a practical example from one of our panelists today regarding their impact measurement system. Then continuing with the implementation of the VPSI approach, since venture philanthropy aims to build stronger investees organizations, it would be logical to expect that much of the funding was going to support investees' core costs. But in fact, as you can see on the slide, only 23%, so 12 plus 11% of the entire amount spent was allocated to core costs in fiscal year 2015 by our respondents. Plus, we see a remarkable increase in the percentage of funds going to restricted areas of expenditure. And this is a puzzling result that we will discuss further with one of our panelists in the second part of the webinar. Additionally, in our latest survey, as you can see in the slide, a huge percentage of the total spend was allocated to the other category. And some respondents, when we asked, replied that they were not really able to split their investment in the categories we provided them with. And then, talking about the last finding we would like to present you today, let's look at the perceived value of non-financial support. So as in previous years, also in our latest survey, we didn't have direct access to the investee organizations, but we asked the venture philanthropy and social investment organizations whether they measure the perceived value to their investees of the non-financial services provided. And as you can see in the slide, only 26% of venture philanthropy and social investment organizations measure this important data, showing that the value of non-financial support is still difficult to quantify for the vast majority of organizations. So normally we finish the first part of this webinar, and I really hope you have found it interesting. And now I would like to leave the floor to my colleague Priscilla, who will moderate the second part of the webinar.
Thank you very much, Alessia. This was very interesting, and I think it's very nice to see that there are a number of trends that are confirmed from one year to the other, whereas there are also some new trends that, of course, need a little further explanation. So I would like now to move on to our panelists that have kindly joined us today to look at their point of view. And I would like to start with Elodie Novick. As you can see, and as Alessia mentioned earlier, Elodie is from Investisseurs et Partenaires, which is one of our members in France, and she is the ESG and Impact Director. So Elodie, as Alessia was mentioning earlier, your organization invests in SMEs that are based in sub-Saharan Africa, and as we can see also on this slide that Alessia presented in the latest EVPA survey, we saw that Africa continues to be the second most attractive region for venture philanthropy organization right after Western Europe. We know that IMP recently published a report about investing in the development in Africa, and so we were thinking that maybe you can provide us with some interesting trends that have been identified in the study.
Hello everyone, thank you Alessia and Priscilla for having me on this webinar. So I work for Alessia and Partenaires as you were mentioning, and indeed we recently released a study that we made together with FERDI, Foundation for Studies and Research on International Development, and this study is focused on impact investment in Africa, and more specifically on how impact investment can contribute to the new UN Sustainable Development Goals. The full study is available on our website, so do not hesitate to download it. I will try to give you probably the main trends with some key figures on impact investment in Africa. As we saw on the slides that Priscilla was commented, the first thing is that Africa today is a major market for impact investment. This is quite clear. Among EVPA respondents, Africa represented 14% of the investment, and in the latest GENE study, which is a different sample of people, it represented 1/5 of impact investment funds in 2015. And it's the second area of destination worldwide, just behind North America. And the second thing which is interesting is to see that Sub-Saharan Africa also emerged as a region where the highest number of respondents today plan to increase allocations in the future. So it's also going to be very dynamic in the years to come. And perhaps two other trends that we see. The first one is that it's very dynamic, but there are huge geographical disparities. Investments are indeed very concentrated in some regions, such as Southern Africa and East Africa. Western Africa, where IMP is involved a lot, represents only a very, very small share of the total. And even in these two regions, Southern Africa and East Africa, investments are also very concentrated in a few countries. For example, South Africa and Kenya in East Africa. And within West Africa, it's highly concentrated in Nigeria and Ghana. More generally, what we see is that African least development countries that are one of our key area of focus at INP only represent 14% of impact capital disbursed in Africa today. And this disparity by this geographical disparity is also and there is also a disparity, a strong disparity across sectors. Because if we look now at the sectors, we see that microfinance represents 1/3 of assets managed. It is the highest ranking sector and far ahead of other sectors. And perhaps among other sectors, I can mention a few, which are housing, manufacturing, energy, agriculture, and infrastructure. And quite surprisingly, actually, social sectors such as education and health, which represent huge needs in Africa, are sectors of interest for many investors, but represent only very few deals. So there is really something to do around this social sector that are quite represented. So that was, you know, perhaps some impact investment in Africa from this study.
Thank you very much, Elodie. Of course, we will share the link with the audience afterwards, as someone just asked on the questions. And of course, I encourage everyone in the audience to continue sharing their questions, which we will ask our panelists right after their interventions. So I think another thing that perhaps is interesting for you to comment, given your position as ESG and Impact Director, is this second trend around impact measurement. So indeed, as you can see on this slide, it looks like venture philanthropy organizations are aware about the difficulties that exist in measuring the impact itself and prefer measuring results only at the levels of outcomes. So we know that Investisseur and Partenera is being cited by the Impact Measurement Working Group of the Social Impact Investment Task Force as one of the cases of good implementation of the impact measurement approach. And of course, you also collaborated with EVPA in redacting a practical case on how to measure impact. So perhaps you can explain to us, given your experience, what are the main issues that you have encountered when you were setting up the impact measurement system at INP?
Okay, so yeah, thank you, Priscilla, for this question. INP was created in 2002, and in fact, it was only 10 years after INP started its activities in Africa that we put in place an impact measurement methodology. And it was when we launched our new fund, INP Afrique Entrepreneur. It was in 2012, so five years ago. At that time, we were scaling up our activities, and we really felt the need to better value and assess the impact generated by our partner SMEs in Africa. And the first thing we did is that we started working on our impact thesis. That was the first step, and our specific impact objective. And we worked with an external consultant, which proved to be very useful, actually. Our focus is really to assess and monitor the SME's contribution to local development. And what we do is that we use a stakeholder approach. For each of our SME, we collect and analyze indicators on their local stakeholders in Africa. So for example, on employees, number of employees, number of direct creation of jobs, and so on clients, on local subcontractors, can be distributors, suppliers, to see all the knock-on effects that can be tracked on the ground in Africa. And we also track indicators around fiscal contribution to the state budgets in Africa. And we use input indicators such as the size of our investment, the time spent, the technical assistance provided, you know, this kind of thing. Also output indicators such as which can be actually company specific. So, for example, if we invest in a maternity clinic, we're going to track the number of babies born at the clinic. If we invest in an agribusiness company, we're going to look at the number of tons of fruits and vegetables produced. You know, this kind of thing, various indicators. And we also track outcome indicators. For example, the creation of jobs at the portfolio level, and in comparison to the amount we invested per company. And that's for us, as it is closely linked to one of our key impact objectives, which is to create decent jobs in Africa. For us, we consider it as an outcome, as one of the outcome indicators that we analyze and collect every year. But to answer your question on impact, do we measure impact, and what kind of challenge we have with measuring impact? In fact, we don't measure impact in a scientific manner because measuring an impact in a scientific manner means that we would have to answer the question, what would have happened without our investment? And to do that, it's very complicated because first you need to focus only on one company and one dimension of the impact of a company. For example, if you are invested in an agribusiness company, you will look at the impact on local producers if the company works with local producers. But you can only focus on one dimension because it's very complicated, because you need to build a counterfactual, which means that you need to have a control group. For example, local producers that would not work with the company. And then it takes a lot of time because you need to conduct several rounds of survey in the field to see how the impact evolve over time and to see the comparison between the producers working with your invested company and producers not working with your invested company. So it's a lot of money, it's a lot of time, and we consider it as quite disproportionate, and you only capture one dimension in one company. So it's really not our philosophy to go to that, because it's for all these reasons. And what we do is not measuring impact, but to go beyond only these quantitative indicators. Every year we conduct a detailed case study in one or two portfolio companies to go a bit deeper, to understand more in a more detailed manner the dynamics at play for the generation of impact. And these in-depth case studies are based on field research, but without building a counterfactual. And our objective is to analyze in which way the SME contributes to the impact objectives it has set for itself. And the objective is not to prove the impact, but to improve the impact and to improve the way the company operates its business. And very often, we come up with a very practical recommendation that help our companies learn about their customers, learn about their suppliers, and so on, with the action that will, in the end, benefit their stakeholders and also their business. So really win-win possibilities. So that's the way, it's a summary, of course, the way we see impact measurement and what we do.
I would encourage everyone who's following this webinar to read the case of Investisseurs and Partenaires, which is of course available for download on our website. And I would like to thank you, Elodie, because I think the point you're making about impact measurement being really proportionate, but also useful to manage better, to achieve greater impact, I think it's a very important point. And I think it's very much in line with the characteristics of venture philanthropy. So once again, thank you very much, Elodie, for your intervention. I think I would like to move now. Of course, there are questions for you. We will tackle them all at the end of the interventions of all our panelists. So I would like now to move to Caroline Mason. Here we go, who is the Chief Executive of Esmee Fairbairn Foundation. So ESME Fairbairn is a venture philanthropy foundation, so a little bit different, of course, from Investisseurs and Partenaires, which is an impact investor. So Caroline, we know that ESME's Fairbairn Foundation investment priority is to achieve a societal impact. So the societal return is considered as priority over the financial. But how do you deal at ESME with return expectations and with the actual realized returns you have? Is there a discrepancy, or how is it evolving at ESME?
Hello. Hi.
Yes, now we can hear you.
Hi. Yes. So to answer that, what I thought I'd quickly do first is to give a bit of a tiny background to how I've come to the conclusion that I come to. ESME has been a bit of context. So ESME has been involved in impact or social investing since 2005. And we started because one of our grantees came to us and said, can we have a loan instead of a grant? Because of that, the way we started was to actually start investing in the infrastructure necessary, because we realized there was then a need and a demand, so we started investing in the infrastructure. So we're unusual because we are both a wholesaler into intermediaries. We were one of the first investors into Charity Bank, into CAF Venture Sum, into a lot of the funds like Big Issue Invest. So we're a wholesaler into funds, but we also do direct investments straight into, so we are in fact an impact investor as well, a direct investor. To date, we have invested in approximately 120 investments, of which 19 are funds. So we've invested in 19 funds as a wholesaler, and then the rest are direct, and 6 social impact bonds, and then the rest are direct investments. We've done debt, equity, quasi-equity, guarantees, asset purchases, so a completely broad range. To date, we've committed about £45 million, and we our initial purpose was not to make money, actually. Our initial target was to aim to recover at a portfolio level the capital outlay net of costs. So we wanted to get a total return of 0% net of costs. We just wanted our money back. And we take quite a lot of risk. So our minimum is 60,000 and our maximum is $1 million. We do quite often take quite a lot of risks into very new models. We're often the first investor into something. But what we've found over the last, that actually at the moment are, over time, what's happened is our net return across the portfolio is not 0, it's 2%. And at the end of last year, it was 1.6%. And the end of the year before, it was 1.2%. So what we're finding is, as the market matures in the UK, and there's that actually our returns are getting, we are able to generate returns. We're definitely an impact first investor, so we will negotiate the returns that we expect based on the amount of impact we're going to create. So, or the investment will create. So we're not a finance first, we are absolutely an impact first investor, but oddly enough we've found that, and I think that's as a result of the maturity of the market, that we're getting better as investors as we learn more, yeah, so we're seeing returns for us improving.
Thank you very much. This is very interesting, and I think we'll discuss it maybe further after all the interventions with other panelists, also because there are a couple of questions coming from the audience. But just for now, moving on, second question I wanted to ask you is around another trend that we have identified in the industry survey. We see that our respondents are increasingly co-investing. Can you maybe tell us a little bit more about your experience, Ismail's experience with co-investing? So which are the advantages of joining forces with other investors, and which are potential issues that you have identified in this year's collaborating with other actors?
So we do a lot of co-investment. Obviously we're in 19 funds, and that has meant that we've obviously and also in 6 SIBs. So, you know, we have co-invested quite considerably with lots of people within the same investment. But we also just do share a lot of deals, just ordinary deals with people. I mean, for us, it obviously minimizes the risk for us, because we don't really want to be the only investor, although not the key investor, because that makes the risk much greater, although we have done that. So I think it minimizes or we share the risk. It's a more diversified risk. We all learn better from it. I think actually if we share the learning of what happens, it's just better. But what we've learned is that it's really, really, really important to make the effort up front, to make sure that all the investors are actually aligned around the whole risk-return impact trade-off. And because when things go wrong, which they often do go wrong actually, and they go wrong in mainstream financial services as they do here, when things go wrong, if you're not aligned, it gets really messy and really sometimes quite unpleasant, especially for the organization who is at the receiving end. If you have co-investors arguing and pulling the organization in all different places, that's really, really poor for everybody. So good alignment up front, taking the time to make sure that there is really, really strong alignment up front is definitely worth doing.
Okay, thank you very much, Caroline. I would like now to move to Daniel Novick, who is the Program Director of the Balkans at Yunus Social Business. So I think a question for you would be that the results of our industry survey tell us that there is more and more of a tendency towards long-term commitment. We've seen it in the results earlier, 6 to 10 years, it's increasing. So Yunus Social Business is a clear example of patient capital. And in your experience, what are the advantages for an investee, so a social purpose organization, to have long-term capital? And eventually, what are the issues related to giving long-term support to investees?
Yeah, thank you, and thanks for having me today. Yeah, as you mentioned, that it is within our
Daniel, we can't really hear you. I think there might be a problem in the connection. So I think we're just gonna.
Oh.
Yes, you are cutting off. But yeah, let's try again. Nope. Okay, so perhaps we will try to have Daniel on the line a little bit later because the audio connection is not so good. We can perhaps move now to Lisa, and then we'll come back to Daniel at the end, if it's okay with everyone. Lisa, you're there. I see you're there. So Lisa is the lecturer at the Department of Strategy and General Management at ESADE, but it's a very important person for us, the EVPA, because she's the one who set up the Knowledge Center some years ago, and she's also very much involved still with our activities. So Lisa, since you know the survey, since you set up the survey actually, perhaps I'm going to ask you all the difficult questions. So I'm going to ask you to comment on the 2 most complicated to understand trends we've found. So the first one is indeed this allocation of funds. So we know that venture philanthropy is a high engagement that's supposed to cover the core costs of the organization supported. But from the results of the survey, we've seen that there is a decrease in the amounts going towards overhead costs either in an unrestricted way with payment linked milestones or towards cover cost with predefined payments. Whereas there is quite a surge in the amount that it's going towards restricted areas of expenditures. So perhaps, Lisa, you can first start by commenting on this bizarre trend.
Thank you, Priscilla, and thank you for giving me these wonderful and challenging questions. So I guess looking at the results, it's, as you said, quite puzzling, and it's first I thought it was almost a bit worrying, because as you mentioned, the venture philanthropy model is really, one of the big differences between venture philanthropy and perhaps what we sometimes call traditional philanthropy is really that instead of providing grants to specific projects, venture philanthropy is trying to support the entire organization, so really trying to build stronger organizations funding the core costs. And what we see here is really an opposite trend. It almost looks like the venture philanthropy organizations are no longer supporting core costs. So I would say that, if you start digging into the data, what could be an explanation is really that the venture philanthropy organizations are tying the funding to more specific areas of support, meaning that they're becoming a bit stricter in terms of what exactly it is that they're trying to do in terms of helping the investees. And I would be very happy then afterwards as well to hear if this sounds correct as well with the practitioners that are our panelists as well on this webinar. But one explanation could be that in terms of actually defining how to spend the money by supporting the investee. It could be tying the money, for example, to a specific area of improvement, which might be, having identified that the investee needs a new marketing plan or, needs help with impact measurement, then the funding is actually directed to that specific area. That could be part of the explanation. Another part, which I think might also explain part of it is also that the venture philanthropy organizations might not really be comfortable with these categories that we have, or that EVPA has sort of put forward in the survey, so that they don't know exactly how to allocate the funding according to these categories. That could also explain why other is quite a big portion now. It might mean that they prefer to actually state the allocation in a different way, and it's not really offered by EVPA. And I think in either case, it's an interesting area to research further. And I also think that I would like to highlight that EVPA has been conducting research in the past on various best practices, including impact measurement and management, non-financial support, exit strategies, and so forth. But actually the big area missing is financing instruments, so tailored financing, which is one of the big core practices of venture philanthropy. And I'm sure that, Priscilla, you can tell the audience more about the project that you're launching, but I think that it's very important because the Knowledge Center is launching a project on financing instruments where EVPA will find out more about how the financing is done. And I think some of the questions to address would be, how and when do venture philanthropy organizations use different types of financing instruments? What types of restrictions do they impose on the investees? How do they incentivize investees through the financing? How is the financing tied to the non-financial support? And I guess also, how do venture philanthropy organizations structure the funding when they co-invest, which, as you have identified, is one of the trends. And is that different if the co-investment is done with private or public funders? So there are lots of very interesting questions that the Knowledge Center is now going to investigate further. So I welcome that research project. Perhaps moving on to the second topic that you asked me to address, which is the non-financial support. And as mentioned, you know, EVPA has been conducting a research study on this, and I guess the two pending issues there, it's really the difficulty of assessing the cost and the value of the non-financial support provided. What we can see in the survey results is really that this is confirmed again, you know, so only 26% of venture philanthropy organizations are measuring the perceived value of the support they provide to their investees. Although, I mean, this has increased slightly compared to previous years, there's still a need to conduct evaluations of how venture philanthropy organizations are helping their investees. And I guess, I mean, what we see also from this survey is that, you know, some venture philanthropy organizations are asking external evaluators to do this, which makes a lot of sense because, as you know, if you're funding an organization and then you ask them if the non-financial support and the funding it's useful for them, you know, there might be a bias in their answer. You know, they might actually not be that willing, or they might even be scared to provide a very honest answer, and it makes sense therefore to use an external evaluator if, as a funder, you're actually really interested in finding out you know, what kind of support is most useful for the investees. And I think that you know, most of the organizations that are part of EVPA, you know, have this interest in actually finding out if the funding and the non-financial support that they're providing is actually producing an impact. So I think this is a really fundamental question for the sector. The other question is more about the cost of the non-financial support, and I think we're seeing also in this survey that you know, although there were a couple of questions that were addressing the cost of the non-financial support, there was no really good answer provided. And EVPA had provided a sort of a way of monetizing the cost of the non-financial support, but it looks like practitioners are not really following this practice yet. So, I mean, some difficulties here. It's really about it's trying to assess what is the cost of non-financial support, because as you know, it's provided by different types of people. I mean, sometimes it's the staff of the organization, of the foundation or the fund itself, so the investment managers, the program managers that are providing the non-financial support. Sometimes it's board members, sometimes it's external paid consultants, sometimes it's pro bono consultants. And in the publication that EVPA came up with last year, EVPA recommended to account for all of these different inputs into the investment process so that the cost could be compared and ultimately to the value delivered. But as we can see from the survey, this is not really done yet. So I think there's also a need for training on this and more information for to practitioners on how to do this. And I guess, I mean, the purpose of doing all this analysis, and that's why I'm also interested to hear from the practitioners if this makes sense to you, would really be then to be able to analyze if the analyze the value of the support provided by the venture philanthropy organization compared to the cost. So it's really a cost-benefit analysis in a way, but ultimately you're trying to understand the efficiency and the impact of the venture philanthropy approach. So then finally, some of you might know that EVPA has been working on a project proposal that aims to do exactly what we now discussed, is to measure the value of the venture philanthropy organization's support on its investees. This project has been put on hold for a while due to some changes that have taken place internally at EVPA and so on. but I'm actually very pleased at this point to announce that EVPA and ESADE will be collaborating on launching this project finally, starting with a pilot including 10 to 15 venture philanthropy organizations, and we'll be reaching out to you to see if you would like to participate in this study, which I believe could provide very valuable information for venture philanthropy organizations on, how much impact they're actually having on your investees. So also, if you're interested in taking part of this study, don't hesitate to reach out to either me or Priscilla for further information. So thank you very much, Priscilla.
Thank you very much, Lisa. This was very good, and also thanks for the nice words about all the work of EVPA. So I think we can try and see if the communication with Daniel is restored. So if Daniel, if you can hear me. So the first question that I had for you was around the duration of the commitment, because as we've seen from the industry survey, long-term commitment is increasing. I would be very interested to hear from you what are the positive aspects of this, and what are the potential issues of being financed for too long.
Sure, thanks. I hope you can hear me now.
Yes.
Great, perfect. Yeah, I'm in Germany now, and sometimes this is more of a developing country than the other countries we work in when it comes to internet connection. Sorry about that. So talking about long-term capital, I mean, obviously, a lot of the decision whether you want to provide long-term capital or not is really linked to the sectors, the maturity, and obviously the risk appetite your organization has for investing into impact. But our DNA, obviously, as you mentioned, is really about focusing on patient finance, and we offer loans or convertibles that have 5 to 8 year maturity and grace periods of up to 24 months. And we really think that the businesses we're targeting need this kind of financing because they are at an early stage where they've created some attraction already, but they still need to stabilize their organization and grow it, so they need some room to breathe to actually scale their impact and their organizations. But last year, we actually conducted a survey with 150 social entrepreneurs in our countries to validate whether that is actually true, whether our assumptions hold true in all of our countries. So we wanted to identify their needs in terms of financial and non-financial support. And actually, there's a similar study out there by the Small Foundation, which is more focused on agriculture, but actually yields similar results. And one of the obvious ones is that, yes, organizations do have, at the moment, only access to short-term capital, especially in geographies like developing countries, like we're active in. So mostly they're trying to get access to capital from banks in most of the countries, because the venture capital and impact investing scene is not always as developed as we would like it to be. So if they want to get access to a bank finance, then obviously, even if they can qualify, they can rarely afford the collateral, which is sometimes 100% to 200%. They can't afford the interest rate, and usually those kind of loans have 2 to 3 years repayment cycles, and that's something an early stage company just usually struggles with. And just to give you an example, actually from Eastern Europe, we've been talking with entrepreneurs there, and there seems to be a program that's called a startup and social startup banking program that is intended to provide social entrepreneurs access to bank finance. But one of the criteria there is that you have to have 2 years positive statements, so 2 years of profit in the business. If you have 2 years of profit, there is not much of a startup criteria that apply to your business. So we have validated that most of the entrepreneurs actually do need short-term capital, but there's also a balancing act, and that's something else we found from the survey, which was more surprising to us actually. There seems to be something like an optimum in the duration of the capital as well as the grace periods that we provide. During the study, we had actually offered a couple of financing products to the entrepreneurs with different conditions, and one of our favorites was actually a 7-year convertible with a 5-year grace period, where they would have only to pay the interest, and then after 5 years, once the business is stable, they can start actually repaying the loan when it shouldn't be a problem for them anyway. But surprisingly, most of the entrepreneurs actually said they don't want to wait that long to pay it back, not just for the capital cost linked to it, but also because they wanted to have that pressure on themselves and their organization to actually make traction work. They were favoring grace periods more in between 12 to 24 months. That was a big surprise for us, and a learning we took out of really trying to validate our financing offer with entrepreneurs on the ground. And we've seen that actually also in the results that if you're too laissez-faire, i.e. you're paying too long-term capital, at some point you fall into danger of slipping into an assumption that it's almost a donation or a grant, where entrepreneurs don't actually remember, oh, I have a loan I have to repay. We've seen it in the past. So there is a very sensitive optimum that you will have to look at when you're structuring your financing vehicles, and I like that there is actually an initiative starting looking at that on the EVPA side, because we really think that VPOs need to have an in-depth look at their clients before they start offering financing tools.
Thank you very much, Daniel. This is really interesting, and indeed I think this proves even more that we really need to do some more research on how tailored finance works, and look also at the dimensions of the duration of the commitment, because some of the practitioners' assumptions might be completely reverted. So we will definitely share the results of the study as soon as we have them. And I'm very happy that you are participating in this research. So you just gave us an example from Central and Eastern Europe, so perhaps we can then move to the geographic area of investment. So you, as Yunus Social Business, invest all over the world, so from Africa to Latin America, but also in Central and Eastern Europe. And I think that one of the puzzling results we had from this survey is that Central and Eastern Europe attracted only 2% of the total funds available. So since you are also active in Eastern Europe, can you tell us maybe a bit more about your experience and if there is potential to generate societal impact in CE, and what are the issues of investing in CE? And of course, you can, if interesting, if needed, you can also show us some comparison with the experience you have in Latin America and Africa, given that Yunus is such a worldwide spread.
For sure, for sure. No, I mean, I have a passion for Eastern Europe for several reasons, and I really think there should be more money going into it. But it really is a chicken and egg problem in Eastern Europe. So one is obviously the funding, the kind of the lack of interest from investors, apparently. But the other one is the pipeline, the lack of actually social entrepreneurs that brought their social innovations to scale. And I'll talk about scale in a minute here, but bear with me. So why is that? Why do I think is that? Well, I think we cannot discuss CEE without the historic angle. And I grew up in Eastern Germany, so I got a very mini glance of what system change means, and it was more severe, obviously, in many of the CEE countries. But this kind of personal and private impact of such a system change that CEE has seen in the past years is actually something that many individuals and many people underestimate. I can still remember my mom, just as an example, my mom went to a supermarket for the first time in Western Germany, and she was standing in front of a refrigerator board with, I think it was 5 or 6 different versions of milk at different prices. Coming out of the socialist system, you couldn't believe that. She felt like she was being cheated. How can you supply such a simple product as milk at 6 different prices? So from the very beginning, we had to learn market capitalism from scratch, even for simple things such as making customer decisions. And we're not even thinking about and talking about entrepreneurship here. Of course, Eastern Germany was very fortunate in the development, from socialism to market capitalism, but other countries were even less so. And there was a lot of promise linked to market capitalism in many of the countries that wasn't fulfilled. I don't want to go too much into the detail here, but we all know all the favoritism that went on during privatization in many of those countries. So it really swung the pendulum from socialism, communism to really neo-Manchester capitalism, a very extreme form of capitalism. And now we're coming back to the region and asking them to combine social and entrepreneurship. And I think to some extent we're, I think, overwhelming sometimes people in Central and Eastern Europe with system changes and with programmatic changes a little bit too much. When we came to the Balkans, we started in Albania. When we started talking about social business, nobody knew the concept, and everybody was thinking we were bringing back socialism. So these radical shifts in thinking about socialism, thinking about capitalism, but then rethinking capitalism, as we're doing at the moment, is not really easy for a region like Eastern Europe. And individuals still have, inherited kind of the collective memory that the state will take care of them, so they personally don't really feel responsible for their society. And if they do, they revert to options like building traditional charities. So this development, the learning curve, I think is something that we have to be patient with people and entrepreneurs in Eastern Europe. And we see a lot of inspiring social entrepreneurial examples in the region, but a lot of them actually started by Western profiles, by individuals from the West that came to the country. And on top of that, you have small markets. I mean, looking at Montenegro, we have 300,000 people living in Montenegro. In other countries, you wouldn't even call it a city. Kosovo has 1 million, Latvia 2 million, Estonia 1.5 million. So if you compare that to other countries like Uganda with 40 million, which is expected to double in the next 2 decades, or India with over 1 billion, where at least in India alone, 300 to 400 million are living in poverty, you really have problems with scaling your social innovation. In Central and Eastern Europe, where markets are so fragmented, it's difficult to really scale the innovations. And that's actually where we enter the numbers game on the investor side. So now we're talking about the pipeline where we see challenges with mentality, but now we're going into the investor side, where we've seen a trend of effective altruism. So, focusing on SROI, so how much impact can I actually create for every dollar that I invest, which is great because we're bringing new efficiency to philanthropy. And we've actually supported a organization in Serbia called Catalyst, which is also working on bringing more transparency into philanthropy. And that's great. But there's also a flip side we mustn't forget, that there's almost like a Darwinistic process in selecting markets when you're a donor or investor. So where am I going to get the most impact for the buck? So where can I get real impact? And I just wanted to give you 2 examples here, as you said, in comparing 2 of our geographies. We see a lot of investment cases each year. And I've been, in one of those weeks, I've been in an investment case for Kosovo, where a really dedicated entrepreneur wanted to build a business in agriculture supporting about 100 smallholder farmers. In Kosovo, with 1 million people and with people really not so much dedicated to social entrepreneurship, this is a real role model. This is real difficult to do that in a country like Kosovo. And we were really excited to invest in it. But then in the week later, I was in an investment committee for Uganda, where we talked about a very similar project, but which was focused and which was delivering impact to 10,000 women farmers. The impact and the investment tickets weren't so different, but it really was 100-fold difference in impact. So it's a difficult numbers game that we can hardly win in Central and Eastern Europe. And honestly, when you look at the EVPA study, this is a great example. I think it's something we really need, and I've been filling in the survey for the last 2 years now, or 3 years, even though it takes some time, because I really think it's important for our sector to gather those numbers. What we shouldn't do, and this is something where we have a challenge in CEE, is we shouldn't reduce our work only and exclusively to number. And then, after all, we're all about creating impact, right? And behind this impact, there are people, faces, and motivations. So in the end, every single one counts. For the CEE, we have to change the narrative. We really have to show examples that impact their society deeply, change it profoundly, even though maybe they don't live up to these large number expectations that we see from most funders that we're also working with. for obvious reasons. It's all fair, it's just a blip in the system that we have to work on.
Thank you very much, Daniel. I think this was extremely interesting, and I think it's a very interesting analysis that you give. We tend to think that Europe is all the same, but indeed there are regional differences that we can't ignore. I think, first of all, I would like to thank all of our panelists for the time that have dedicated to us. We have some questions from the audience that Alicia has been compiling. So perhaps, Alicia, you can read some of them and we can ask our panelists to answer them.
Yes, thank you, Priscilla. So maybe we can start with a question from Nea Chandogozia. And it's a question direct to Caroline. And basically, Nea is asking Caroline, Elodie mentioned that measuring impact is complicated to the onerous process of calculating additionality. And do you see similar issues when doing impact measurement in UK? Maybe, Caroline, you can comment on that based on your experience in United Kingdom.
So I'm afraid we take a very non-technical view of impact, because actually we don't really think impact's a particularly technical thing. I think we spend a lot of time as investors worrying about attribution, additionality, counterfactual, but actually the reality of the world is just very, very messy, and so we actually use a rating system. A little bit like, I really like the phrase, we want to improve rather than prove. We have this idea of that actually we want to contribute, not, so we think about contribution, not attribution. So I think a lot of impact, the impact isn't ours. We are just facilitators and enablers of organizations to make good things happen. So we ask for 3 outcomes and 3 indicators. We are a core funder with a presumption for unrestricted funding. So we basically say at the beginning of 3 years funding or a 7-year investment, give us 3 outcomes and 3 indicators of where you think, what it is you're trying to achieve. And then we use a rating system as a proxy for performance at the end of every single relationship, every single investment, where we track our performance. We rate our own performance. Did we get it right as an investor or as a funder? What mistakes did we make? We look at the outcomes and we rate, because also, again, sometimes over 3 to 5 years, lots of things can happen. Who would have thought a year ago that UK was going to leave Europe, Brexit, inflation, different, so different government, different policies. So, and those are things that will happen, and there's nobody's fault. Policies can change. So when we rate the outcomes, we look at what was achieved, how it was achieved, was it achieved well. Sometimes something different will happen, but it might be even better. So that gives us the flex. So, and then thirdly, so we rate our performance, were the outcomes achieved, and if not, why not? And then thirdly, we rate the organization as a whole and say, is it in a stronger place? So have we improved that organization's resilience and ability to thrive? Yeah, so that's, as I said, we don't really do measurement of impact because we think that's a very reductive way of thinking about it.
Okay. Thank you very much.
Thank you, Caroline. And there's another question related to all the discussion of Lisa about the allocation of funds. And maybe, Daniel, you can give us your some example from your experience and comment about this allocation of funds and the results we got from our survey. So Daniel, I will mute you. And so, okay, Daniel. Maybe no.
Hello?
Yes.
So,
No?
Now it works.
so yeah, so I would like maybe to ask you something about yes, your experience with allocation of funds. So maybe you can just yeah, give your perspective and point of view.
You're saying allocations in terms of what the SPO can use the funds for, right?
Yes. Yeah.
Okay. Yeah. Yeah. I mean, again, it comes a bit down to what maturity you're looking at, and as we're looking at early stage companies, obviously we do look at business plans, but we all know that business plans usually don't survive first customer contact. So it always comes differently. So our funding usually is provided on a budget basis, but we tell the entrepreneurs on how, that they can basically use it as they see fit, within some restrictions. So for major decisions, major investment decisions, we as board members or as the financial supporters, we are part of the decision. But for their main operating decisions, they can use the funds in a free way. And it's something that links actually with our patient financing approach. We want to be seen as a partner rather than a bank or even a development organization. We have a risk appetite because we also want to invest in businesses that have particular scale. So that also means that we have to give them the freedom to act and the freedom to react to market changes, to changes in their client behavior, and really build the businesses that they think hit really the market demand. So from our perspective, we are working on a budget basis, but more lenient, and I think it's the only way to go really at early stages in supporting the businesses. What becomes important if you do that we see on our end is building the relationship with the entrepreneur to create trust between the VPO and the SPO, and at the same time also making sure you invest in the right teams that are able to manage growth and manage the scale. If you do that, then your allocation doesn't matter so much anymore.
Okay, thank you so much, Daniel. And maybe now we can go back to Elodie because we received questions from the audience regarding the impact measurement. And so the question is maybe measuring the counterfactual could be useful for proof of concept for very innovative risk investments. So maybe I can, yeah, Elodie, you can. Elodie, maybe
you can answer this question. So basically the question is around whether the counterfactual can be at least useful when you are in the proof of concept phase. But I don't know, maybe we lost Elodie. I think we lost Elodie.
Okay. Voilà, Elodie?
Hello?
Yeah,
Yes.
Elodie, I think
sorry, I couldn't unmute myself. I had just a technical issue. So I think that's right, that in some circumstances, of course, it could be interesting to do a kind of randomization study and to especially it's true when you have an innovative business model that you would like, that has a lot of potential for replication. Then it can be interesting because the cost invested in the study can be leveraged by the fact that there is a huge impact potential, and that you really need to check if your new business model or idea has a positive impact. And sometimes you're surprised by the results. I think what happened with microfinance is quite interesting in that point of view, because donors had invested huge amounts of money in microfinance, and at one point in time it was really interesting to conduct studies to see if microfinance had the impact it claimed to have on its clients. So I think with this view it can be interesting, and we are quite open to that if we have the opportunity to partner with a larger organization that has the financial possibilities to support such a project. And for example, we had discussions a few years ago. Finally, it didn't happen, but we had a discussion with the World Bank on randomization on a specific gender issue in microfinance, and it could have been a nice opportunity. So that's what we would look at, would be, I think, setting up partnerships with larger organizations which have the financial means to do that, and also the means after to use the results and communicate around these results. So that's what I would say.
Okay, thank you so much, Elodie. And now we have questions for Lisa. So, and it's about corporates. And since Lisa is an expert, since the VPA, we are also running works about corporates and the involvement of these actors in the VPSI sector. I will address you this question. So is, what do you think is the reason why companies are not so much involved in VP? And maybe they have they have a corporate foundation, and corporate social responsibility is not able to be active in VP space. So maybe if Lisa, can you just tell us something more about the involvement of corporates in the VP space to try to answer this question. Thank you.
Yes. Okay, so I guess in terms of how corporates are involved, EVPA did a study about corporate impact strategies where you know, it was highlighted that corporates had basically 3 different strategies to generate social impact through their, you know, that was connected to their core business. So one was more in terms of inclusive business. So for example, making sure that their value chain is, you know, having, you know, is complying with all these different standards in terms of environmental and sustainability and governance issues, but also in a very proactive way, trying to generate impact, you know, in most of the things that a corporate is doing. But we also then saw that one way of doing this could be through what is called corporate impact venturing. So this is more for the corporate to be investing in social enterprises or social businesses that would be a source of innovation for the corporate. So it could be perhaps less risky to engage in this way than to change the entire business. And then a third way was through the corporate foundation. So actually by having the corporate foundation engage in using a venture philanthropy approach. So some examples of that we saw in that study was the Shell Foundation and the CNA Foundation that were using the fund. Well, in the case of the CNA Foundation, the foundation is then using, you know, is trying to generate you know, opportunities for the sector, the textile sector. In the case of CNA, you know, which the corporate itself cannot do because it's more long term. It's more about building markets. It might not have a profit generating motivation at all, but you know, in the long run, it could benefit the entire textile sector. So an example would be investment in organic cotton. So there are actually lots of things that corporates can be doing to engage in this area, and we're seeing lots of very innovative examples of that. And I guess that perhaps in a survey like this, that might not be so well reflected, but such strategies are definitely being implemented.
If I may add from my end, we're also doing a lot of work with corporations besides our core business. We've set up a couple of joint ventures actually, where corporates have created separate businesses that are really looking at social impact, and it's been an interesting journey. And I think the potential here for the venture philanthropy sector and for VPOs in general is that one of the success factors we've seen in working with the companies like, McCain, Cisco, like Danone, Adidas, was the network of partners that they would create around their joint venture. Because ordinarily, corporations are used to going out themselves. They're not so used yet to building partnerships. But if they want to actually venture into social entrepreneurship or creating impact businesses, then they need partners. And a critical factor that BPOs can play there is really making sure that the social side of the venture pulls through, and not just the financial and sustainability side.
Okay, thank you so much, Daniel and Lisa. And I don't know if Elodie or Caroline would like to add something on this topic.
Yeah, just to say, go ahead. So in the UK there are two things I think. One is there's quite a big initiative here around corporates using their supply chain to as commissioners of impact, I suppose, and there's a group that have committed to spend $1 billion through their supply chain to charities and social enterprises, and that's headed up by Social Enterprise UK. And then the other thing is the government has created an advisory group with all the main pension funds and savings providers here in the UK to see how they can create retail products to encourage retail investment into impact and creating new impact retail products. So those are two initiatives that are happening in the UK. So I think there's quite a lot going on in this area, which is great.
Great, yeah. And thank you so much, Caroline, for your comment and experience. So if Elodie has no more comments on it, I don't know, Elodie, or if not, okay, great. So unfortunately, we don't have time anymore for questions, but I would like to thank all the participants for their inputs, and of course panelists that answered to our questions. And if you, of course, have other questions that we didn't answer during this webinar, feel free to contact us via email afterwards. And so before closing the webinar, we would like to remind you that all the formats we produce is linked to the data we collected. So as you can see, the survey report, the survey infographic, and the survey interactive report are available for download on our website. So don't hesitate to go and visit our page. And then, as I briefly mentioned at the beginning of the webinar, we officially opened the registration for the next 2 EVPA Impact Management workshops organized by EVPA and Social Value UK, which will take place on 16 and 17 March in Brussels. And yeah, as you can see on the screen, basically there will be 2 different courses, so the fundamentals and the advanced training. And it is possible to participate in both courses or attend just one of the 2 according to the experience. And of course you can find all the details on our website. Then thank you again so much for this interesting debate, and thank you once more to our panelists, and don't hesitate to contact us. Here you can find our contacts. And at the end of the webinar, a very short survey will pop up on your screen. And as your feedback is very useful to improve what we do, we would greatly appreciate if you could take 2 minutes to fill this in. And of course, the recording and presentation of today's webinar will be made available on our website as well in the course of next week. And as the last thing, we would like to thank the European Commission for its structural support to our activities. And again, thank you all, stay tuned, and good afternoon. Bye.